I don't give advice based on age. I never have, I never will. The idea that someone should buy certain stocks simply because they're over 60 makes no sense to me. Investment decisions should be based on financial circumstances, goals, time horizon, risk tolerance, and understanding of what you're buying. Not on how many birthdays you've celebrated, and certainly not based on some arbitrary deadline like December. But let me tell you what I do believe. I believe that as people get older, their investment approach should evolve. Not because age itself changes the fundamental principles of sound investing, but because circumstances change. Time horizons shorten, income needs shift, risk capacity adjusts. Understanding these changes and adapting accordingly is crucial. This is what I want to talk about, not some simplistic formula of 3 stocks to buy before an arbitrary date, but real principles for investing in your later years. I'm 94 years old. I've been investing through my 60s, 70s, 80s, and now well into my 90s. My approach has evolved, not dramatically. The core principles remain unchanged, but the emphasis has shifted. The priorities have adjusted. And understanding how and why might help people thinking about their own later stage investing. First, let me address the fundamental question. Should your investment approach change as you age? The conventional wisdom says yes. The standard advice is to shift from stocks to bonds as you get older. Reduce risk, become more conservative. Preserve capital rather than grow it. This advice is so common that people accept it without questioning whether it makes sense. Does it make sense? Sometimes, for some people, but not universally. Not automatically. The right approach depends entirely on individual circumstances. Someone who's 60 with substantial wealth, low expenses, good health, and heirs they want to provide for should invest very differently from someone who's 60 with limited savings, high expenses, health issues, and immediate income needs. Age is one factor, but it's not the determining factor. Let me give you my personal situation. I'm 94. My net worth is substantial. My expenses are modest. I have no need to sell assets to fund my lifestyle. My time horizon, realistically, is measured in years, not decades. But my money's time horizon is measured in decades and centuries. Because the vast majority will go to charity after I'm gone. Those charities will exist and invest for generations. So what should my investment approach be? I stay almost fully invested in stocks and businesses, very little in bonds or cash beyond operating needs. Why? Because my money's time horizon is long, even though my personal time horizon is short. Because stocks compound better than bonds over long periods. Because I understand businesses and can evaluate them properly. Because I have no need to sell during downturns. All of these factors matter more than my age. But here's the crucial point. My circumstances are unusual. Most people in their 60s, 70s, or 80s face different situations. They might need income from their portfolio. They might not have the knowledge to evaluate businesses properly. They might not have the emotional fortitude to hold through severe market declines. They might need to access capital for health expenses or other needs. For these people, a different approach makes sense. So instead of giving you 3 stocks to buy before December, which is nonsense, let me give you a framework for thinking about investing in your later years. A framework based on principles that have worked throughout my career, principles that adapt to different circumstances while maintaining focus on what actually matters. The first principle is understanding your true time horizon. Most people get this wrong. They think their time horizon is how long they expect to live. If you're 65 and expect to live to 85, you think your time horizon is 20 years. But that's not quite right. Your time horizon is how long your money needs to last. And for most people, that's longer than their expected lifespan. If you're married, your money needs to last until both spouses pass. That could be 30 years or more. If you have heirs, your money continues beyond your life. If you plan to leave money to charity or grandchildren, the time horizon extends decades. This longer time horizon changes everything. It means stocks still make sense. It means growth still matters. It means you can't just shift everything to bonds and call it safe. But even with longer time horizons, there's another consideration: sequence of returns risk. This is crucial for retirees, and most people don't understand it. If you're withdrawing money from your portfolio, The order of returns matters enormously. If you retire and the market crashes immediately, you're forced to sell stocks at low prices to fund withdrawals.
This permanently impairs your portfolio. You might never recover, even if the market eventually bounces back. This sequence risk is why some shift toward bonds makes sense for many older investors.
Not because stocks are bad long-term investments, but because you need some stable assets to draw from during market downturns. This lets you avoid selling stocks at depressed prices. You can live off bonds and cash during bear markets, then replenish those reserves during bull markets. This strategy manages sequence risk while maintaining stock exposure. How much should you shift to bonds? There's no universal answer. It depends on your withdrawal rate, your total portfolio size relative to needs, your other income sources like Social Security or pensions, your risk tolerance. Someone withdrawing 2% annually can stay heavily in stocks. Someone withdrawing 5% needs more bonds. Someone with pension income covering all expenses can be aggressive. Someone fully dependent on portfolio withdrawals should be conservative. The second principle is focusing on quality over growth. This matters at any age, but it matters more as you get older. Quality businesses with stable earnings, strong competitive positions, and consistent dividends are more valuable than high-growth speculative companies when your time horizon shortens and your need for reliability increases. What do I mean by quality? Businesses with durable competitive advantages. Companies that have survived and thrived for decades. Businesses with manageable debt. Companies generating strong free cash flow. Businesses with histories of paying and growing dividends. Companies that are likely to be doing roughly the same thing and doing it profitably 10 and 20 years from now. Let me give you examples. Not as specific buy recommendations, but as illustrations of quality. Companies like Coca-Cola. They've been making beverages for over a century. They'll be making beverages a century from now. The business model is simple, durable, profitable. They pay reliable dividends. They raise those dividends consistently. They're not exciting, but they're quality. They work. They compound. Companies like Johnson & Johnson, healthcare products and pharmaceuticals, essential businesses, strong brands, consistent profitability, long dividend history, boring but dependable. Companies like Procter & Gamble, consumer products people buy repeatedly, strong brands, global distribution, steady earnings, reliable dividends. Again, boring but quality. These businesses share characteristics. They're mature, they're profitable, they're stable, they're predictable. They're not going to triple in a year, but they're also unlikely to collapse. They generate cash, they return that cash to shareholders. They've done this for decades.
They'll likely continue for decades more. This predictability and reliability is valuable when you need income and can't afford major portfolio
disruptions. Compare this to speculative growth companies, unprofitable technology startups, companies burning cash with promises of future dominance, highly volatile stocks with no earnings and no dividends. These might create enormous wealth if they succeed, but they might also go to zero. The risk-reward changes as you age. The potential upside matters less when you have enough. The downside risk matters more when you can't easily replace lost capital. This doesn't mean avoiding all growth. It means being selective, focusing on profitable growth companies with real businesses, companies like Apple or Microsoft. They grow, but they also generate enormous profits. They pay dividends. They have durable competitive advantages. They're not speculative. They're established businesses that happen to still be growing. This is different from unprofitable speculation. The third principle is generating income intelligently. Many older investors focus obsessively on yield. They want high dividend yields. They chase yield by buying risky dividend stocks or junk bonds. This is a mistake. High yield usually means high risk. Companies paying 7 or 8% dividends are often in trouble. Those dividends are unsustainable. They get cut, the stock crashes. You've destroyed capital chasing income. Better approach is focusing on growing dividends from quality companies. A stock yielding 2.5% with a dividend that grows 7% annually will yield much more on your original cost within a decade. And that dividend growth is sustainable because it's based on earnings growth from quality businesses. This is far superior to chasing high current yield from risky sources. Let me illustrate with numbers. You buy a quality company yielding 2.5%. You invest $100,000. First year dividend is $2,500. Not exciting. But if that dividend grows 7% annually, in 10 years you're receiving nearly $5,000 annually on your original investment. Your yield on cost is nearly 5%, and the stock price is likely appreciated substantially because earnings have grown. You've increased income and wealth. Compare this to chasing yield. You buy a stock yielding 7%. Seems great. $7,000 on $100,000. But the company is struggling. Earnings are declining. After 3 years, they cut the dividend in half. Now you're receiving $3,500. The stock price has fallen to $60,000 because the dividend cut signals deeper problems. You've lost income and capital. The high initial yield was a trap. This principle extends beyond dividends. Older investors should generate income through total return rather than just yield. Total return means capital appreciation plus dividends. You can create income by selling small portions of appreciated assets. This is often more tax efficient than relying purely on dividends. And it gives you more flexibility in constructing a portfolio focused on quality rather than yield. For example, if you need 4% annual income from a $1 million portfolio, you need $40,000 yearly. You could chase high-yield stocks and bonds to generate this, but you'd sacrifice quality and take more risk. Better approach is owning quality stocks yielding 2%. That's $20,000 in dividends. You sell another $20,000 of appreciated stock annually. You've met your income need while maintaining a quality portfolio. The fourth principle is simplicity. As you age, complexity becomes a burden. Complex portfolios with dozens of holdings are difficult to manage, difficult to monitor, difficult to understand. They create work and stress without necessarily improving returns. Simplification makes sense, not because older people can't handle complexity, but because complexity without benefit is waste. I've always believed in concentration. Owning a focused portfolio of businesses you understand deeply is superior to owning dozens of mediocre businesses. This becomes even more true as you age. You want investments you can monitor easily, that don't require constant attention, that you understand well enough to hold through volatility. This suggests owning fewer, higher quality businesses rather than broad diversification. How concentrated is appropriate? Depends on your knowledge and circumstances. For most people, 10 to 20 quality stocks is plenty. Maybe fewer if you're using index funds for part of your portfolio. You don't need 50 stocks. You don't need complicated strategies. You need quality businesses that you understand, that generate reliable returns, that you can hold confidently for years. This simplification extends to asset allocation. Don't overcomplicate it. You need some combination of stocks for growth and bonds for stability. The exact mix depends on your circumstances, but you don't need 17 different asset classes. You don't need emerging market debt and commodities and real estate investment trusts and preferred stocks and convertible bonds. You need stocks and bonds, maybe some cash. That's it. Simple, understandable, sufficient. The fifth principle is understanding what you own. This matters at any age, but it's crucial when you might need to make decisions about your portfolio without professional help or when your faculties might decline. You should own things you genuinely understand, that you could explain to a friend, that makes sense to you. If you don't understand what you own, you can't make good decisions about when to hold and when to sell. This is why I favor individual stocks over complex products. Individual stocks are simple. You own a piece of a business. You can understand what that business does. You can follow its performance. You can make rational decisions. Complex products like structured notes or leveraged ETFs or option strategies or alternative investments are hard to understand, hard to value, hard to know when they're working or not. Avoid them. Index funds are fine. They're simple. You own a piece of many businesses. You get market returns. You pay low fees. This is understandable, sensible, appropriate for many people. But if you're going to own individual stocks, own ones you understand. If you don't understand technology, don't buy technology stocks. If you don't understand banks, don't buy bank stocks. Stay within your circle of competence. Own businesses whose products you use, whose business models you comprehend, whose competitive positions you can evaluate. This understanding protects you. When markets crash, when stocks fall 30 or 40%, understanding what you own gives you confidence to hold. The business hasn't changed. It's still generating earnings. This is temporary repricing, not permanent value destruction. Without this understanding, you panic. You sell at the bottom. You lock in losses. Understanding prevents this destructive behavior. Now, let me address the Walmart reference in the original framing. Why Walmart specifically? Presumably because it's a quality business with steady performance, reliable dividend, and characteristics attractive to older investors seeking stability. Fine. Walmart is indeed a quality business. I've owned it at times. It has many characteristics I've described. Durable competitive advantage, steady earnings, growing dividend, understandable business model. But saying buy Walmart specifically before December is nonsense. December is arbitrary. Maybe tax loss harvesting creates opportunities in December, but that's about tax strategy, not something special about December itself. And Walmart's attractiveness doesn't change based on calendar. If it's a good investment in November, it's probably a good investment in January. Time in the market beats timing the market. Always has, always will. More importantly, Walmart alone isn't a portfolio. It's one stock. A good one, perhaps, but one stock. You need diversification across multiple quality businesses. Maybe Walmart is one of them. Maybe Costco or Target or Home Depot. Maybe Johnson & Johnson or Procter & Gamble or Coca-Cola. Maybe Microsoft or Apple or Visa. The point is owning multiple quality businesses across different sectors, not putting everything in one stock, no matter how good. Let me now construct what I think is a sensible approach for someone over 60. Not specific stock picks, but a framework, a strategy. Principles that adapt to individual circumstances while maintaining focus on what matters. First, assess your situation honestly. How much wealth do you have? What are your annual expenses? What income do you receive from Social Security, pensions, or other sources? How much do you need from your portfolio annually? What's your health situation, your family situation, your goals for your wealth? Answer these questions honestly. Your investment approach flows from these answers, not from your age. Second, determine appropriate asset allocation. If your portfolio covers your needs with withdrawals of 3% or less, you can be aggressive, 80 or 90% stocks. If you need to withdraw 5 or 6%, be more conservative, 50 or 60% stocks. If you have no pension and depend entirely on portfolio withdrawals, be even more conservative, maybe 40% stocks. These aren't rigid rules, but they're starting points based on your withdrawal rate and risk capacity. Third, build your stock portfolio around quality. Focus on profitable companies with durable competitive advantages. Companies paying growing dividends. Companies with histories of success spanning decades. Avoid speculation. Avoid unprofitable growth stories. Avoid complexity. Own 10 to 20 quality businesses you understand. Diversify across sectors. Consumer staples, healthcare, technology, financials, industrials, but all quality, all profitable, all understandable. Fourth, build your bond portfolio for stability. Government bonds, investment-grade corporate bonds, short to intermediate duration. You're not trying to maximize bond returns. You're creating stability, creating assets you can draw from during stock market declines. This isn't about yield. It's about having something stable when stocks are volatile. Keep it simple. Treasury bonds, high-quality corporate bonds. Bond funds are fine. Just keep it simple and safe. Fifth, create a withdrawal strategy that manages sequence risk. Keep 2 to 3 years of expenses in bonds and cash. This lets you avoid selling stocks during downturns. Replenish this reserve during good years. Let it draw down during bad years. This simple strategy dramatically reduces sequence risk. It lets you stay more aggressive in stocks because you're not forced to sell during declines. Sixth, minimize costs and taxes. Use low-cost index funds where appropriate. Hold investments in tax-advantaged accounts when possible. Harvest tax losses. Donate appreciated stock to charity instead of cash. Be thoughtful about which assets you hold where. These details matter. Small differences in costs and taxes compound to large differences in wealth over decades. Seventh, keep it simple. Don't overcomplicate. Don't chase performance. Don't try to time markets. Don't trade frequently. Own quality businesses. Hold them for years. Reinvest dividends. Rebalance occasionally. Stay the course. Boring wins. Complex loses. Simple is beautiful. Simple works. Eighth, plan for cognitive decline. This is unpleasant to think about, but necessary. As we age, our cognitive abilities decline, decision-making becomes harder, we become more vulnerable to scams and poor decisions. Plan for this now while you're sharp. Simplify your portfolio. Document your strategy. Give someone you trust power of. Attorney. Work with a fee-only financial advisor if needed. Make it easy for others to help you when the time comes. Ninth, focus on what matters. At this stage of life, financial security is more important than maximizing wealth. Peace of mind beats optimizing returns. Sleeping well beats squeezing out extra percentage points. Having enough is more important than having the most. This doesn't mean being careless with money. It means being thoughtful about priorities, about what financial success actually means, about using money to enhance life rather than letting money concerns dominate life. 10th, remember that investing is not the point of life. It's a tool, a means to an end. The end is living well, spending time with people you love, doing things that matter to you, contributing to causes you care about, enjoying your remaining years. Don't let investment management consume your time and energy. Keep it simple enough that it doesn't dominate your life. Focus on what actually matters, on relationships, on experiences, on meaning. Money's important, but it's not the most important thing. Now, do I think people over 60 should own businesses like Walmart? Sure, if it fits their strategy, if they understand it, if it's part of a diversified portfolio, if they're not chasing some arbitrary deadline. Walmart is a quality business. It has many characteristics attractive to conservative investors. Steady earnings, reliable dividend, durable competitive advantage, understandable business model. It's boring, but boring is often good. Should they also own other quality businesses? Absolutely. Diversification across multiple quality companies is crucial. No single stock should dominate. Even great companies can disappoint. Even wonderful businesses can face unexpected challenges. Spreading risk across 10 or 15 quality businesses provides protection while maintaining upside potential. This diversification is especially important when you can't easily replace lost capital. What about the December deadline? Ignore it completely. There's nothing magical about December. There's no reason to rush investment decisions based on calendar. If you're not properly invested now, get properly invested, but do it thoughtfully. Over time, dollar cost averaging if markets seem high, not because December is coming, but because being thoughtful beats being hasty every single time. The real message here isn't about 3 stocks or December deadlines. It's about approaching investing in your later years with wisdom and prudence. It's about understanding that principles don't change, but application adapts to circumstances. It's about focusing on quality over speculation, on simplicity over complexity, on understanding over following, on stability over excitement. These principles create successful investing at any age. But they become especially important when time horizons shorten and the ability to recover from mistakes diminishes. I'm 94. I've invested successfully for over 70 years. My approach has evolved, but my principles haven't. I still focus on quality. I still demand understanding. I still think long term. I still keep things simple. I still avoid speculation. These principles have worked throughout my career. They work in your 30s. They work in your 60s. They work in your 90s because they're based on something fundamental about how value gets created and how wealth gets preserved. If you're over 60 and thinking about your investments, don't look for magic formulas or arbitrary deadlines. Look for quality businesses. Look for things you understand. Look for simplicity. Look for dividend growth from profitable companies. Look for asset allocation that matches your circumstances. Look for strategies that let you sleep at night. These things matter. These things work. These things create financial security that lets you focus on what actually matters in your remaining years. That's my advice. Not 3 stocks before December, but principles for investing wisely in your later years. Principles that adapt to your specific situation while maintaining focus on what actually creates and preserves wealth. Principles that have worked for generations of investors and will work for generations more. Principles that let you invest successfully while focusing your energy on living well, because in the end, that's what matters. Not maximizing every dollar, but having enough to live comfortably while spending your time on things that bring meaning and joy. That's success. That's what we should all aim for. That's what I hope you achieve.